Ever wondered how a financial crisis could bring the world to its knees? Today we delve into the gripping tale of the 2008 recession. A drama of epic proportions, it unveiled how a housing bubble burst in the United States could trigger a financial meltdown that rippled across the globe. This crisis was not an isolated event confined to Wall Street or the United States. It was a domino effect that toppled economies worldwide. Millions of lives were affected, countless jobs lost, and entire industries were brought to the brink of collapse. It was a stark reminder of our global economy's interconnectedness. But why should this matter to you? Well, understanding the 2008 recession helps us grasp how financial decisions, regulatory policies, and economic factors interplay to shape our world. So, buckle up as we rewind to the start of the 21st century and the beginnings of a crisis. The fuse of this financial time bomb was first lit with the subprime mortgage crisis. Imagine this. You're a bank, and you've got a brilliant idea. You decide to lend money to people who aren't in the best position to pay back. These folks, often with low income or poor credit history, are considered high-risk borrowers, and you're giving them loans to buy homes. These are what we call subprime mortgages. Now, why would a bank do something like that? Well, the housing market was booming. Prices were going up and away. The thought was, even if these borrowers default, the bank can seize the property, sell it off, and still make a profit because property prices were always rising, right? But here's the catch. The housing market isn't a one-way street. What goes up can and did come crashing down. The bubble burst. House prices plummeted, leaving these high-risk borrowers with loans much higher than the value of their homes. Suddenly, the bank's brilliant idea didn't seem so brilliant anymore. Unable to pay off their loans, borrowers started to default. Banks seized properties only to find they were worth far less than the loans they'd given out. Foreclosures skyrocketed, and banks were left holding the bag. The fallout was catastrophic. Many financial institutions had bought and sold these risky loans, repackaging them as mortgage-backed securities. When borrowers began to default, the value of these securities took a nosedive. Banks and financial institutions worldwide who'd invested heavily in these securities found themselves sitting on a mountain of worthless assets. The dominoes had started to fall, and the financial institutions found themselves on the edge of a precipice. So, the subprime mortgage crisis wasn't just about a few bad loans, it was a systemic problem, a financial contagion that spread throughout the global economy, setting off a chain reaction that would lead to one of the most significant financial crises in history. Panic ensued as the crisis spread, and then came the shock that reverberated across the globe, the fall of Lehman Brothers. A titan of Wall Street, Lehman Brothers was one of the world's largest investment banks. Its bankruptcy in September 2008 was the largest in US history, marking a dramatic turn in the unfolding financial crisis. Lehman Brothers had been heavily involved in the subprime mortgage market, holding on to a vast portfolio of these risky loans. When the housing bubble burst, the value of these assets plummeted. Lehman Brothers found itself in a dire situation, its balance sheet burdened by toxic assets that were virtually worthless. The bank's demise was swift. Over the course of a single weekend, attempts to rescue Lehman Brothers failed. Barclays and Bank of America, considered potential saviors, backed out of deals, leaving Lehman Brothers with no choice but to file for bankruptcy. This sent shockwaves through the financial world. The fall of such a significant player confirmed the fears of many. The financial system was on the brink of collapse. The Dow Jones Industrial Average plummeted by over 500 points in a single day, the largest drop since the aftermath of the 9/11 attacks. The impact was felt far beyond Wall Street. Markets around the globe reeled from the news. Financial institutions, already wary due to the subprime mortgage crisis, now faced a new level of uncertainty. Trust evaporated, credit markets froze, and a global credit crunch ensued. The Lehman Brothers bankruptcy was a defining moment in the 2008 financial crisis. It was a clear signal of the severity of the situation, shattering any illusions that the crisis could be easily contained. It marked the moment when the financial crisis became a global economic crisis. The world had officially plunged into a recession. The stage was set for a period of economic hardship that would affect millions of people around the world. The fallout from the Lehman Brothers bankruptcy was just the beginning, and the full impact of the crisis was yet to be felt. The aftermath of the recession was a cruel reality for millions. In the blink of an eye, the world we knew had shifted on its axis. A tidal wave of job losses swept across nations, leaving a trail of uncertainty in its wake. From the bustling cities to the quiet suburbs, no corner was untouched by the ripple effects of this financial tsunami. Imagine waking up one day to find your livelihood snatched away. This was the harsh reality for countless people as companies struggling to stay afloat had to let go of their employees. The job market, once brimming with opportunities, now echoed with the chilling silence of despair. But the job losses were just the tip of the iceberg. The housing market, precariously built on the shaky foundation of subprime mortgages, crumbled. Dreams were shattered as homes were foreclosed, ripping apart the fabric of families. Communities that once thrived were now ghost towns, a stark reminder of the devastation left in the wake of the crisis. Consumer confidence, the heartbeat of any thriving economy, plummeted. With jobs lost and homes foreclosed, spending took a nosedive. The wheels of the economy, once spinning at a breakneck speed, ground to a jarring halt. The fallout from the crisis wasn't contained within the borders of the United States. Like a contagion, it spread, infecting global markets. Stock markets around the world, intertwined through the complex web of globalization, tumbled. Businesses faced the harsh reality of credit drying up and access to capital becoming a mirage. From Wall Street to Main Street, from the skyscrapers of Tokyo to the cobblestone streets of Paris, the world felt the tremors of the 2008 recession. The global economy, a colossal machine powered by the interplay of countless elements, was now stuttering. The world was in a chokehold, gasping for financial air. The aftermath of the 2008 recession painted a grim picture, a tableau of job losses, home foreclosures, and a market crash. Yet amidst the ruins, there was a glimmer of hope, a promise of recovery and lessons to be learned for the future. Governments worldwide were forced to intervene, while the public demanded answers. As the financial crisis deepened, governments found themselves in a precarious position. Financial institutions, once thought to be invincible, were on the brink of collapse. In an unprecedented move, governments stepped in to prevent a total economic meltdown. Huge bailout packages were rolled out, injecting billions into the banking system. In the United States alone, the government committed $700 billion to buy distressed assets and equity from financial institutions. This was a desperate attempt to stabilize the banks and restore public confidence. But as we know, it wasn't a quick fix. The recovery was slow, the road arduous, and the fallout immense. Meanwhile, the public watched in disbelief as their hard-earned tax dollars were used to rescue the very institutions that had caused the crisis. The outcry was loud and clear. People took to the streets, protests spread like wildfire, and social unrest was palpable. From Wall Street to London, from Madrid to Athens, citizens demanded accountability and justice. These protests were not just expressions of anger, but also a call for systemic change. They exposed the deep-seated flaws in the financial system and sparked a global conversation about financial regulations and ethics. The crisis had laid bare the consequences of unchecked greed and risky financial practices. The world was crying out for a more transparent, accountable, and ethical financial system. But amidst the turmoil and the outcry, there was also a glimmer of hope. The crisis had shaken the world, but it had also awakened a sense of unity and common purpose. People were no longer just passive observers, they were active participants, demanding change and justice. The world was crying out for change, for accountability, and for a safer financial future. As we look back at the response to the 2008 financial crisis, we see a pivotal moment in history. It was a time of upheaval, but also a time of awakening. It was a stark reminder of our interconnectedness and our collective responsibility to build a more stable and secure global economy. Slowly but surely, economies began to recover. But the landscape of finance had been forever changed. The road to recovery was steep, but with resilience and determination, nations clawed their way back to stability. Governments worldwide implemented reforms to prevent a repeat of the crisis. Financial institutions faced stricter oversight and regulation, promoting transparency and accountability. The crisis also acted as a catalyst for change, sparking conversations about the ethics of the finance industry and the need for sustainable financial practices. It forced us to question the status quo and seek better, more robust solutions. Through the ashes of the recession, new opportunities emerged and valuable lessons were learned. The 2008 recession was a stark reminder of our global interconnectedness and the need for vigilance and sustainable solutions. It taught us that we must be prepared for financial storms and that we are more resilient than we think. We must remember these lessons as we move forward into the future.